and ready, set, cool. All right, so we have this titled right now as like Intro to Options, but you know what I will say about this community is like it's probably one of the most advanced communities out there. So congrats, number one. If you're in LKS, low key songs, I will say it's probably one of the most mature communities out there. So this presentation that we have, it's more kind of like it is the intro to options, but it's also like the truth about options. So before we go into it, if you guys haven't seen me and like what I do have a channel in the server. What is it called here? It's I don't know that they call me Paper Profit, right? I just lost our chat. It's a server channel. Like you'd have to select the roles. Lexa can kind of help you out on that. But just quick background, I do come from Silicon Valley. If you don't know, I did come from like enterprise technology. I worked there for forever. I left about a $400K a year, maybe a little bit more, job in Silicon Valley selling enterprise tech, which, interesting enough, to the companies that we trade all day. Like Snowflake was probably one of my largest companies, right? Like Uber, huge company, like DoorDash, giant company, Robinhood, one of my biggest customers. So I do have a lot of background, like knowing these companies from a fundamental perspective, oddly enough. So I kind of took that edge initially in terms of the fundamental perspective, but I started getting into trading way back when, many years ago. A lot of people will say, like this is how many years I have experience. I put 15 years here, active market participant. Honestly, I'm kind of old, but if I took like my years from like, oh, this is the first year I bought a stock, it would be many more than 15 years. If you really want to count from that, it's like, I don't know, 20 something, 25 years. But full-time trading, I'd probably say like over 5 years, maybe 7 years, without any other job. So I have been out of enterprise tech for a while, but all those companies that I just mentioned, yeah, those are the ones I actually helped build. When I left, I went and I actually sat down with a lot of like the major market makers back in the day, the guys who literally wrote the books of advanced options and things like that. I sat down and I spent probably like 2 years side by side with basically, if you don't know CBOE and OIC, CBOE is Chicago Board of Exchange, OIC is Options Institute, or Options Industry Council. They had, like way back in the day, they had trainers of like advanced option strategies. So the guys that would really teach about like volatility and things like that. I spent a ton of money back in the day just to be able to sit down next to them and learn from them. So to me, it was a big deal to be able to do that. You can't really do that anymore. But what ended up happening was I found out that, look, these guys were amazing at understanding volatility, which became part of my specialty. But they weren't really the best traders in the world, if that makes sense. They were so good, in fact, that they could create some crazy spread trades that basically gave them the ability to not have to be that great of traders and still make money in the market. So we used to have in the server like spread trading channels, which Zephyr knows. He's down there in the audience. But like there are ways that you can leverage options to do things like that and be somewhat okay in your price action. But when it comes to Discord, most people ended up focusing on price action, and I think that is actually ideal, right? But with the background of honing in on volatility and then being able to focus on price action, I was actually able to find a pretty small niche in the options world of identifying low cost but high probability option trades, and that landed me pretty much square into the Discord community of almost like people learning how to trade options, maybe some small account challenge type of users, people that are just entering the options world, don't have, millions of dollars to trade, but want to get their feet wet and looking for some kind of setups that could have some explosive returns. And for me, options I always saw as kind of like the great equalizer, right? Like real institutions, I'm going to be very frank with you guys, aren't actually trading large dollar options. Like that's more of like hedging stuff. Options were legitimately initially built as hedging tools. They were not built as trading tools. So to be fair, options are not investment tools. They are tools built to hedge equity positions. And until you're able to really build up, a multi-million dollar portfolio, it doesn't, it's a daunting task to be able to get there and make those kind of gains. But options give you the ability to kind of like level that playing field. And especially if you understand things like volatility and when to buy options and when not to buy options, that gives you a really, really good advantage in the market, especially if you're starting, right? If you're starting, you have to learn how to trade. Investing is never going to be like a full-time gig. There are going to be years in the market where sometimes, investing can be, like quote unquote, like an income. But you guys have all known, like you guys know now, like maybe after seeing the market for the last few years, there are going to be times in the market where things just aren't going to pan out, or your $100, Nvidia goes from $400 to $100 and your investment just tanks, and then you sell for a loss, and next thing you know it's $700, right? But in that drawdown period, it was very painful, right? So investing in those times is not easy, right? It's very, very difficult. But regardless, if you're able to leverage options, and I'm going to click to the next slide. I don't want anybody, I'm very hesitant to show this, but it is true. Like this is a real P&L balance. This is a 1 week return. And ask for a screenshot of something. This is a 1 week return, 7.3 to 7.10. I have a small account and I kind of ran it. This is $1 million week, right? And so if you're actually leveraging options and you end up rolling, you can take a few $1,000s and continually compound returns over a period of time and get into that multi-million dollar portfolio by compounding those returns, right? This is definitely possible, but you have to build into this stuff over years. I'm just saying, you can work towards this. It's absolutely a thing. The truth about options. Yes, we're doing a quick one. Anyways, so here's how we go. So what we're gonna do is we're gonna talk about like trading options, how we first get into them, things like that. So I just showed you guys, that's kind of like the money rainmaker boils. You guys are hilarious. Like I said, I was very hesitant. People want to see this, right? This is the screenshot that people drool over. This is real. You can't make this stuff up. But it's all about sizing, right? Size matters, right? A little goes a really long way. You don't just start into something like that. I will tell you this right now. When you have $1 million week, your cheeks are clenched the entire week. It's not necessarily fun. I'm probably never going to have to do that. I'm probably never going to do that again, right? Like, it's just like, it's a little wild. We get into things called bid-ask spreads. I'll talk about that in a little bit. But the point is, my cheeks are always clenched. The point is that you don't need a whole lot to get a lot of return if you learn how to use options right? You can literally start with a couple $1,000 portfolio, and I think that's where a lot of people, especially a younger crowd, that's where a lot of people are really looking to start. And even if you're not younger, as an aside, even if you have a $100,000 portfolio, I will still say take a couple $1,000s out, put it off to the side, and that's what you want to start with, right? You don't start, if you have $100,000, it doesn't matter if you're starting with $100,000 or you're starting with $1,000. Regardless, percentages are percentages. You can blow $100,000 just as easily as you can blow $1,000. It doesn't change, right? So a little goes a long way. I started with $500 in November, RXN. That's perfect, right? Honestly, we just did a CrowdStrike swing trade just last night. I opened it for $100, Today it went to $350. That's one trade, right? It's a good trade. Doesn't always happen, but honestly, like, it only takes a couple of those, and to be able to compound things like that, like over and over, that's all it really takes, right? If you're able to identify those kind of setups and those kind of situations, I'll tell you this: it's not with earnings. That's not the time to do it. Those are gambles. Like, those are gambling situations. That's not how we do it, right? Certain things, I'll tell you guys right now, you might see us trading a lot on Fridays. I'm going to give you this rule number one. If you're the type of person that wants to trade a lot on Fridays, look, our rule is if you don't have profits for the week, you don't trade on Fridays. So just take that one really easy, simple rule. Don't trade on Fridays if you don't have profits from Monday through Thursday, right? When you're learning, you just really need to fight the urge to size up, right? You have to earn sizing, if that makes sense. So if you're starting with $500, that's fine. What you guys are going to do is you're going to find an account size that actually matters, or actually feels comfortable. So like practice, right? If you can't manage, again, a lot of people come out and they're like, oh, I wish I had a $500,000 account. I would be able to make so much more, right? It's just not true, right? If you can't manage a $5,000 account, there's no way that you'll ever be able to manage a $500,000 account, right? And holding through conviction, it's not even about conviction, I would say. It's a lot about accepting the loss before you open up a trade, and that, I think, is what's going to be key, right? And that's part of the psychological piece of trading. We can talk about that in a little bit, but once you have conviction, the money just flows. Sometimes it flows out, right? But I'll tell you, conviction isn't always your best friend. I will say that sometimes my highest conviction trades are my biggest loss. Most times my highest conviction trades are my biggest losses. But I'll move on. The point of this is to tell you, when you're building your account and you're trying to build up into size, what I would suggest for anybody out there that's looking to learn is to find a comfortable account size that you're able to manage for a consistent period of time. So if it's $500 or $5,000, that's fine, right? Let's say RXN is now I'm at $2,500. I lost beginning January, one half. January started at $500, learned a lot over the past few months. So let's say you're someone that started at $500 and now your account is about $2,500. What I would say is go ahead and take your withdrawal. Maybe pull it back to $1,500. Does this make sense? Are you following? And then see if you can bring it back up to $2,500 one more time, right? But if you take that $1,500 account and you kind of crush it back to $500, well, that was your starting point. You're still okay. I wouldn't redeposit. I would just, play with it and see if maybe worst case, you're back to $500, and then you work that $500 back up to $2,500 again, take another withdrawal. But you find that account size that you're initially comfortable with. For some people, it's $1,000, honestly. For some people, the $1,000 account is like that account that they find themselves constantly being able to take $1,000 account and turn into $2,500. I think that's a good number, especially for a lot of newer traders. And what I would say is actually once you take that $1,000 account, you bring up $2,500, boom, withdraw. Withdraw, pay yourself. That's super important, right? Withdraw that $1,500, restart next Monday at $1,000, see if you can do it again. And then all of a sudden you're making $1,500 a week. Like, that's not so bad, right? And then maybe after a few weeks of doing that, you keep it at $2,500 and see if you can bring it to $5,000 in 1 week. And if you can do that, then okay, withdraw another $2,500, restart on Monday with 25, bring that to $5,000, and then you start to build up. See how that makes sense? Exactly, right? And then you're compounding. And all along the way, you've been able to put that money aside, right? That's how trading actually works. We're not always trading with this one giant account that's constantly building. We're not doing that. I'll just tell you that right now, that's not how it actually works, right? All the profits always come out of the account. I'm taking withdrawals usually like once every couple weeks, if not monthly. But every time I have a big day, I'm taking major withdrawals. Today, guess who's taking withdrawal? Yeah, your boy's taking withdrawal, right? It was a great day, absolutely taking withdrawal. My biggest red days, and you guys tell me if this makes sense or if you can relate to this, my biggest red days come right after my biggest green days. There's a reason for that. We get a little overconfident, right? There's something we call the overs when it comes to trading, right? Over trading as if I had no red days. That's because you read Miss Cleo or the tarot trader, who I call Miss Cleo. So overconfidence, number one. If I get overconfident, I tend to have red days, right? If I start over trading, I tend to have red days, right? If I oversize, I tend to have red days. We call these the overs, right? If you ever feel yourself or catch yourself doing these things, you just want to stop, walk away, take a withdrawal regardless. But those are things that you want to watch out for, right? Sorry, so that's a little bit of trade psychology, probably not part of this, but again, it's all part of this sizing thing. The thing about the sizing, if you keep your size manageable, you should never get out of whack in your trading psychology. And this is probably the most important thing. If I'm oversized, that's when my cheeks get really clenched, right? Like if I'm oversized, I get nervous. Maybe I'm swing trading. Guys, if you have a small account, I'm just going to tell you right now, it's probably not a good idea to swing trade in general. There are no stop losses in swing trading. It just happens, right? Things gap beyond your trigger, beyond your stop. You just can't do much about it, right? It's not. Swing trading is not for small accounts, really. But, if I'm oversized, that's when I tend to lose money, right? Like, if I keep my size to a manageable position in general, like, my emotions are always going to be in check, and I'm able to trade essentially, like, within my plan without going outside of my risk parameters, and be able to, like, stay focused on exponential returns and constantly like compounding my profits. All right. So here's today. So that's trade psychology. Sorry. So today what we're talking about though is components of options, right? And so moving on. Most people come into options and they think, oh, okay, so the stock's going up and I want to buy calls, right? Or like the stock's going down and I want to buy puts. So today what we're going to talk about is really like the truth about options. And the thing is that price action, it's just half the battle, right? It's literally 50% of the components about options. Just because the stocks go, how many people, let me ask you guys a question. How many people have tried to trade earnings? I just said earnings trades are probably just gambles, right? Bought a call on a stock that you liked over earnings and and the stock went up, maybe you nailed the price. And then you wake up in the morning, you're thinking, oh, I'm going to bank. And you look at your option and you're like, oh shit, I'm like toast, right? I'll tell you, I did that, right? Legitimately, I remember one of my first trades, and this is probably one where, what got me so like, I was like, I'm not going to make this mistake again. And why I went, and I just went to CBO. I went to the OIC. I was like, I need to figure this out. I remember, okay, I'm going to date myself. So NVIDIA was trading like $50 or $45, something like that, right? And I'm like, it's going to go up. I bought a call. And I nailed the price, right? And I'm like, dude, I'm going to get paid. And I literally, I woke up and I'm like, okay, I'm going to cash it. I was down. I'm like, how am I down right now? But it's because of this thing called volatility, right? So volatility, that's actually the biggest component of options, right? So again, three things to mastering options. So number one, timing, right? We want to make sure our timing is good. Number two is volatility. And number three is we want to be able to leverage volatility to get these what's called exponential returns. So the reason I have exponential returns on this slide right now is because if you're a scalper, let's say someone, and I'm going to define scalper as someone who's trading, whose average time in market is less than 20 minutes. Options are probably not the best thing for you. Right. In that event, I would say probably go check out Chica or check out the options. options. Check out the futures section that they're building out. Futures are going to be your best tool, bar none, right? Options are all about exponential returns, which means that you have to have a sustained move, right? So in options, we need sustained moves to leverage exponential returns. If I'm scalping options, I'm going to be caught with something called a bid-ask spread. I'm going to be caught with like volatility. I need to be dealing with all these other things. So number one, so I need to be good on timing. So we're going to get into that in a little bit. There's certain times of day that you want to trade options, certain times of day that you don't want to trade options. I want to understand volatility, and I want to look for some kind of like more pronounced type of move that's going to be more than a couple minutes, right? I don't want to be scalping options necessarily. So back to that first question, right? So buying calls. So Jason, my first name's Jason. Paper is saying, okay, buying calls, buying puts, right? Long options. This is what we're talking about. So most people go, all right, I think the stock's going to go up. I'm going to buy a call. If it goes up, cool, let's buy calls. But how much am I going to make if the stock goes up? Do you really know, right? And that's the question that I really ask. Okay, stock's going up, you buy a call. How much are you going to make? Most people have no answer for that, right? And then the question is like, okay, you bought a call. How much are you going to lose if it goes down? Then they really have no idea, right? Like, well, yeah, like Greeks will screw you. Yeah, that's the question. Like, do you really even know these kind of things, right? Okay, well, now I think the stock's going to go down. Okay, well, let's buy puts. But if it goes down, how much am I gonna make? Like if it goes down $2, how much you're gonna make? Do you have any idea? Well, maybe you look at Delta, but you know what? Delta only tells you a single dollar move. It doesn't tell you $2. It doesn't tell you $3. That's not what it is. It's only $1 for the first dollar. It's a different number for the second dollar, and it's a different number for the third dollar. Did you know that? Same thing for if it goes against you. What if it goes up in your inputs? How much do you lose? Whole another thing, right? I can go into something. This is how it's priced, right? This is called the Black-Scholes formula. It's kind of cool, kind of not. But honestly, most of the time, people are like, "Oh my God, I can't go through it." So today, I have. Oh my God, you guys are hilarious. So today what we're going to do is I'm going to break options down to 3 basic components, right? And we're going to make this super, super, super simple, right? So options have 3 basic components. There's intrinsic value, which is how much the strike is in the money by. And mind you, if something's not in the money, there's no intrinsic value, right? And then there's time value. That's how much time to expiration there is. And then there's something called volatility, right? So these are the 3 basic components of options, and we're just going to break it down this simple. So time value, I think this, I'm just going to move this a little bit. Oops, I'm missing something. Intrinsic value, I just told you what it was. We're missing some animation, that's fine. So let's say if you have a $100 call on a $100 stock, right? So if I have stock is trading at $100 and I buy a $100 call, I have no intrinsic value. If I have a $100 stock but I buy a $95 call, I have $5 in the money, I have $5 intrinsic value. Does that make sense? If I have a $100 stock and I have a $105 call, I have $0 intrinsic value. Does that make sense? So that means that if I'm out of the money, all I have is time value. And time does have money, right? So that's called your premium. So when people refer to options, sometimes they talk about premium as like the net price of your option. That's actually not true. Premium is what is out of the money value. So everything that's not in the money value. So if it's a $95 call and the stock is trading at $100, and let's say that $95 call is worth $7, just as an example. So $5 of it is in the money. That's your intrinsic value. $2 of it is what we would actually call extrinsic. That's time value. That's your premium. That is what will decay away, assuming that the stock price stays exactly the same, right? That is actually controlled by volatility, all that kind of stuff. Volatility is the one thing that is actually a huge flaw in this pricing model for options, and that's what we're actually going to leverage in terms of being able to find out whether or not we want to buy an option, whether it's a put or a call, those kind of things, right? And we're going to use what we call as average rate, right? So this is just a chart of an option in general. You can just, we're not going to get fancy or anything like that, but what we look for is something that's kind of like basing or sideways for a while. So I took, just as an aside, short index volume, long equities vol. Do you mean volume or volatility? Zephyr. Too funny. Volatility. Yeah. So like, I'm just gonna take. You know what? I'm just gonna take a live trade, really quick. So I did one swing trade yesterday, and this is just the screenshot. And I sent the note. But why did this CrowdStrike trade do what it did? And that's because of this. And if it was just the chart, and I'm just looking at the chart right here, this is CrowdStrike, just on a daily chart, or just this is 30-minute. Even if I was just looking at a daily chart, coming into the trade, right? I sent a note in the swing trade channel exactly why. There was a catalyst. The catalyst being like 4 to 10. From a price action perspective, I have this kind of like double bottom. We're good to go. We had a catalyst. We're basing over what was actually the prior all-time high over here. And this consolidation, and I'm not looking at volatility. I'm not looking at anything special. This was, and I'm just going to show you in time, 15 days that the stock was going sideways. So if anything's going sideways for like 15 days or something like that, Fortnite bucks. If anything's going sideways for any period of time more than a week, that should just tell you, just by looking at the stock, look, these prices on options are going to be extremely cheap, right? Just from a relative perspective. So those kind of things we're looking for, and that's on a longer time period from a daily perspective. So if you're looking at charts and you're scrolling through things, that's what you want to look at, right? You don't want to buy after a move like here's CrowdStrike today with this big old candle that's out of the box, let's call it, right? Now, all of a sudden, we're out of this box. CrowdStrike, what do you think is going to be? Cheap or expensive? Just by looking at it, super expensive, right? Over here, all right, 1, 2, 3, big move. They're going to be pretty expensive, right? You guys are weird. I'm not even sure what box you guys are talking about. Whatever. Anyways, so that's just basic volatility. So that's what we're going to talk about today. We're going to focus on this. I'm going to give you a couple visuals moving forward, but I do want to say, like, here's one thing. The reason why you can just look at a chart. Hopefully, my voice kind of comes back. It sounds like it is. Options are priced based on, and we're going to go back to this really quick. So these three things, I wish I don't have, oh, you know what? There you go, in the money. So this is all of it. So in simplest terms, right, options are based on the likelihood that the strike price expires at the money, right? So I'm going to say this one more time. So options, the pricing model, in simplest terms, are based on the likelihood of the strike price expiring at the money. So if something's been going sideways for any considerable period of time, then the option model, remember, if we go back to that volatility thing, actually the option model assumes that volatility is a constant, right? So in that Black-Scholes formula, this is assumed constant. That's a flaw. You guys know that stocks are constantly moving over time. You guys know that, hey, look, once something starts moving, then it's probably going to continue to move, right? But the model assumes that whatever it is right here, right now, that's the average move. So it's going to assume that as of yesterday, CrowdStrike's average 14-day move, average 15-day move is whatever this is. What is this? So an average move over 15 days is, what is this? $5 or something like that. $10, right? an average move is less than $10, right? All of a sudden, CrowdStrike ends up moving $20 in a single day. Well, the option model had not factored that in, right? We knew from a technical perspective that there was a setup that it could double that move. Man, lost money from SPY. You guys crack me up. Anyways, these are the situations that we're looking for. So again, the options pricing model is based on the likelihood that the strike price is going to expire at the money. So if the stock has been going sideways and it's not typical, at least it hasn't recently made a move beyond X dollars or outside of this range, then the pricing model is not going to assume it's going to be underpriced. It's not going to assume that the stock will likely get there. But this is how we look at it from a statistical perspective. So the probability, so likelihood here means basically probability. We can turn that probability into an average, like an actual percentage. So for us, probability, we can actually leverage something called average range. If you guys are familiar in your server, in the groups, Zephyr, Quantum, they can all tell you guys there's something called ATR, or average true range. On my charts in my channel, you'll actually see something, and I'll show you this on a smaller view. So this is a 30-minute chart for me. What you'll actually see a lot is, oops, I gotta get to live. See these little green dots? So on my charts, I have actually what's called the average daily range, or ADR. So average daily range. And I literally have this on my charts. This is a 14-day average daily range. So I can actually see on my screen whenever something is moving beyond a 14-day average range. And so when we know, what we know is that whenever anything is moving outside an average 14-day range, then our options are going to be exploding in terms of volatility. Because why? Because the actual model in the like options pricing model is having to adjust for that probability live. Because all of a sudden, that last 15 days of CrowdStrike having moved only $5 to $10 now has to factor in a $20 day move, so that average range is expanding, and all the options prices are having to adjust live, right? Like live right now, and we leverage that kind of move in our advantage, right? So those are the things that we're actually looking for. So again, so second thing, strike price. So that was likelihood, right? So second thing, strike price. So as price changes, everything else changes. When I was talking about delta before, that's only the first dollar move, right? So we talk about, in the servers, we talk about this thing called gamma. That's going to be super important. I'm going to show you guys a quick thing on Greeks in a little bit, but just know that delta is only significant for a single dollar move. It is insignificant for the second dollar move. I'm going to give you a quick cheat on like how to find out what's actually going to happen to your option if something does hit your actual full target, to be able to send, like, here's, like, if you're trading, I'll be able to tell you guys within a couple cents really like what your options should be priced at, and I'll give you guys a couple tools on how to actually pretty much swag that with a real level of clarity. Expiration, so time to achieve target. This is super important. People talk about decay a lot. People talk about theta a lot. I'm going to tell you guys right now, honestly, theta should be the least of your worries. If you hear people talking about theta as a thing to be really concerned about, no offense for anybody that has, I don't know. It's honestly, it's a nothing burger, right? Theta is like meaningless to me. Right? What you should be concerned about is something called volatility. And that's what we've been talking about this entire time. Theta is just a 24-hour number on your option chart. It only signifies the next 24 hours. Also, that changes, right? Extended, you're hilarious. But just saying, right? If you hear people talk about theta, don't worry about it, right? What you want to see is if you get something that's moving, you want to see that continued trajectory or that continued velocity, right, of the move. The second that your underlying or your stock or whatever stops moving at the same trajectory, that's when you need to be worried. Because at that point, when we're just talking about CrowdStrike as an example, once that trajectory starts to slow down, all of that like probability average range will start to come back in. So when we were just talking about how the options chain is having to increase the average range of like, and the probability, and therefore all the prices start to increase, once that like average range starts to get smaller and those candles get smaller and smaller, guess what happens to your options? Those also get smaller, right? TLDR, yeah, okay. You guys are hilarious. All right, so, all right, real quick, last one. So at the money, I'm going to talk about a couple of things. So there's at the money. What am I going here? So I'm going to mention something. So expiring at the money, we refer to this in options world as like your moneyness, right? I'm going to give you guys a quick way to leverage that delta, and how to leverage that exponential gain really is that you want to open your option contracts slightly out of the money. You want to plan, if you get your moves right, you want to plan to take profits at the money. And if you're lucky, you want to hold your runners slightly in the money. And if you do it that way and you get that type of trajectory, right, that is when you will get that exponential move. And that leverages the entire range of delta, right? And I'll show you on another slide really quick what that looks like. But that will give you the largest exponential gain. We don't want to hold at the money contracts for very long. Those actually decay the fastest. So just as an aside, right? So at the money, like options, side note, decay the fastest. We want to open slightly out of the money. We want to plan to trim at the money. At the best, you want to hold runners slightly in the money, not too deep in the money. Not too deep in the money. That's not good either, right? But biggest trims at the money. The closer to the money you are, the less of your position you want to have on, but that's where you want to have most of your trims taken out. All right. Sorry, I don't know what's the secret, right? So we talked about the next thing about timing, right? So timing, so all options we talked about. There are intrinsic is the component number one. That's how deep in the money you are. Remember, we want to open slightly out of the money, trim at the money, maybe runners in the money. All options have time value. That's that probability of the contract expiring at the money. So depending on how much time there is on your expiration, the more time you have, the higher probability there is of the contract expiring at the money. That's why the longer those expirations are, the more time you buy, guess what? The more money you're paying. So in general, the truth about this is you actually want to pay as little as possible for your contract. It's not actually like you want to buy leaps and things like that. That's one big myth about options, is that people say all the time, oh, buying more time is safer. Ooh, I hope somebody doesn't really get upset about this one, but buying more time is the total opposite of safer, right? Let's define something really quick. Safe means limiting your exposure in terms of net dollars in the market, right? If I'm paying more money for more time, like if it moves up or down, I'm going to make the same amount of money. I'm going to lose more money if I buy more time. It's not safer, right? So that defining safe as like generally speaking, safe as like limiting my risk, limiting how much money I have at risk at any given time. I actually don't want to be buying a lot of time, especially with a small account. I want to pay as little as possible. I want to like make sure I want to enter exactly when the move is happening, and I want to actually take the majority of my profits out of the gate, right? And I want to make sure that I'm entering when the value is at the lowest point, right before IV starts to elevate. Right? If you are a swing trader, just as an aside note, I know I said you don't want to buy a ton of time. You do want to buy, from a swing trading perspective, probably about twice the amount of time that you think you need. That is like the one caveat, right? I don't mean, look, if you think that you need more than 30 days for a move, you're guessing, right? So at no point should you really be looking at anything more than 60 days out. Just do spreads, right? But here's the thing, right? If you think that there's a move that's going to happen that's going to take longer than 60 days, like, it's just a guess. And if you're guessing, it's a gamble. And the stock market is not the place to gamble, right? Like if you want to gamble, you go to Vegas, right? And that's the thing, right? Like if you're down to gamble, then fine, call it what it is, right? But if you want to make money, you can't be actually gambling. So just keep that as an aside. You don't want to, if you find yourself feeling the urge to buy more than 30, 50 days out in time, you might want to rethink that just for a second, right? If you think that you need 90 days to, like 90 days out in expiration, number one, look at the cost. How much is it costing me to put 90 days of time onto my contract? And honestly, is it really a guess at that point, right? Do I really need that much time, or am I guessing at this point? So back to getting like on track in terms of creating in terms of compounding your returns. So we basically gave you like how to leverage time, things like that. You want to buy as little time as possible. Wait till the move is actually happening. That means try not to anticipate a move, but wait for it to happen. Keep it on point. Like this is when it's happening. I want to go in. I want to buy as little time as possible. I want to capture the move as it's happening, and I want to get out the second it starts to like stall out, right? There are two main sessions of trading, especially for like newer traders, right? I know a lot of people, especially people that are trying to learn and seeing like major gains, things like that. A lot of people tend to want to trade all day long. Hopefully that's new guys, not you guys, but we're on Spaces almost all day, and I will say that there are a lot of traders that do like to trade literally all day. But that's not the most efficient way, right? If you're trying to learn and like get proficient with trading, I would say to create your own personal schedule. Look at your work schedule and find a window that you can actually trade regularly at the same time every day, right? The screen that I have up right now is kind of like the market hours, right? And the market has its own schedule of when volume actually comes in. And there is a very specific time of day that you don't want to be in the market, right? So the main trading hours for the market are the first 2 hours and the last 2 hours. There are two sessions, right? Before the market opens, if you want to trade the opening session, you do want to do your prep about an hour before the open, right? So at worst, maybe 30 minutes. Personally, it probably takes me about 15 minutes, but that's after years of experience. But if you want to trade the open, you need to be on your computer at least 30 minutes beforehand, ideally an hour, just to do your pre-market prep. Look at your charts beforehand, a couple days of data, a couple days of charting, right? Get your key levels, know what you need to see before it actually happens, and make sure that you're in the move as it's happening, right? Side note, don't ever open a trade if you don't know where you're going to get out before you open it, right? And you want to be out within that first 2 hour window. And that's going to be able to keep you on a good day trading schedule. And you'll be able to compound this, right? So if you keep yourself on a schedule, this keeps you out of trouble, right? If you're just learning, look, even if you don't hit your target from a price perspective, if I can schedule myself and know that, look, my trade ends within the first 2 hours of the market being open, regardless, then that's my trade ends after 2 hours of being open. That keeps me pretty clean and regimented and on a schedule. On the back half of the day, right, it's the same thing. There's a 2 hour session on the back half of the day. That's the back half. We call the PM session. You still want to have, like during the lunch hour, so 9 a.m. Pacific, about 10:30 a.m. Pacific, you could start doing some like actual prep. If you're like on actual East Coast hours, you might want to take like your lunch hour and take a look at your charts. You still want to do that prep beforehand, before the actual last 2 hours of the day. And then it's the same thing. You can open sometime within that last 2 hours, but look, the trade ends when the market closes. The trade ends when the market closes, and that's it, right? There's a very specific 2 hour window that you want to avoid for the most part, and that's between 11:30 Eastern to 1:30 Eastern. So it's pretty specific as to why, but that's actually two things. So number one, there's the European close that actually volume totally falls out, and then there's actual like 12 o'clock East Coast time, 9 o'clock West Coast time, where the major traders go to lunch.
and volume falls off, right? It's a legitimate lunch break. So it's actually it's about 8:30 a.m. Pacific, like 11:30 a.m. Eastern. That time of day, you really don't want to be in the market, right? Like sometimes you get these weird intraday reversals, but yeah, Lexa knows exactly the time. So there's this really weird thing that happens. So every day, exactly at this time, there's also this wave of decay that comes across all options. So if you're in the morning session and you're not out before this time, you're going to get hit with the IV crush across the board, even if your trade's going in your favor. So just knowing, hey, look, this is my schedule. This should help you guys a lot. So also as an aside, there are 2 major days this happens. The first day, believe it or not, is Wednesday. Wednesday, this time frame, major wave of decay across the board. It's the halfway point of the week. It's the halfway point of the day. Big decay, right? Friday, you guys know, if you're out, and I'll send what I call time stops. So regardless of price, you will have a time stop, right? And that means that if, no matter what, by this time, if I'm not in an active move on my underline, I need to stop out of my trade regardless. So keep your schedule pretty tight. Give yourself a clean window to trade. And that should help you guys stay more consistent. I told you I would look at something really quick. What is this? So this is Tesla. Obviously, this is a while ago. I wanted to show you guys a quick like screenshot of like what does buying more time really look like. So this is back to that buying more time is safer, right? So again, risk equals dollars in the market, right? So if I'm gonna define risk as net dollars in the market, this is where you really need to question it, right? So here's Tesla currently trading at the time of this screenshot, which was obviously a while ago, 250. Hopefully she gets back there. I mean, since we all got clapped when she was trading 200 anyways. She's coming back up. Anyways, so this is on the left-hand side of the screenshot. This is Thinkorswim, by the way. This is a 5 DTE, so 5 days to expiration contract. So right here, this is a 12-day DTE expiration contract. So this is 7 days extra. Over here, this is a 40 DTE expiration contract. So 5 days, 12 days, 40 days, just as quick view, right? So a 5-day to expiration contract, Tesla's trading 253.86 at the time. You think it's going to go up. This was a quick example. You're looking at a 255 call. The shortest date to expiration, this is going to cost you $5.60. So at the money contracts, this is 2 things I want to know. So 1, price, 2 is delta we talked about. So they're all going to move the same way, right? Any at the money contract, they're all going to have what's called a 50 delta option, like 50 delta. That means that for every $1, that first dollar, they're all going to move $50, right? So no matter what the expiration is, you're looking at 0.48 delta, like an extra week of time. This is going to be $8.45. It's still got a 50 delta, about 0.5, so 0.2 delta. So, but the cost is $5.60. It's an extra $3. It's about an extra $3. So about an extra, what is that, 40%, something like that, for an extra 7 days. Do I want to pay 40% more? I'm going to get the same return, about $50 for the first dollar. If I bought 40 days to expiration, this is $15.90 for extra 40 days for like 30-day plus day to expiration. $15.90. This is literally 3 times the price for more time. I'm literally spending 3 times the price. What's my delta? 53 delta. All right, guys, I'm going to make the same amount of money, whether I spend $560 or $1,600 on this option. No matter what expiration I buy, I'm going to make the same amount of money. So no, it doesn't make sense to buy more time in any situation. That's why it's so important. Also, side note, like volatility, the more time you buy, the more sensitive options are to volatility. So if volatility starts to go down, let's say you don't get the move, let's say it goes sideways, right? The more times you buy, the more sensitive this is. It's actually going to decay on you faster. Also, you have something called delta decay. You can't actually hold on to these for very long. I don't think I have this screen here, but I did have, no, I don't. Shoot. There was one where I actually had a screenshot of these exact options. If it goes against you in this instance, you're actually going to lose significantly more by buying more time on all these. You will lose more dollars on all these. Here's the rub, right, where people get tied up in this. And when we go back to that very first screen, size matters. When we talk about options, you still want to be like quantity same across the board. It would be quantity 1 here, quantity 1 here, quantity 1 here to make that same amount of dollar. It's not quantity 3 here, quantity 1 here. That matters, right? Because you're risking, it's managing your risk, managing your net dollars in the market. If you're doing quantity 3 here and quantity 1 here, well, you're not managing your risk well. I hope that makes sense. That's probably the biggest thing. Because if it does go against you on this, you're going to lose more percentage. But let's say Tesla drops to like, I'm just going to give you this one. So if Tesla were to go up $5, and here was that thing I was going to show you really quick. Tesla goes up $5. It's not a $1 change, so we're going to go $5. So Tesla goes up $5 on this in this instance. The quickest way to know how much your contract's going to be worth is you look $5 in the money, $5 lower, and we're going to look at this 250 strike right here, 835. That's how much it'll be worth. Just as simple as that. It's the quickest swag. It's super accurate, believe it or not. So 560, boom, to 835. That's going to make, somebody do quick math for me, call it about 250, something like that. Over here, if Tesla goes up $5, this 255 strike, we're going to look at this 250. This is going to be worth 1150. So we go 845 to 1110. I'm going to make about 230, maybe a little bit less, about the same amount of money, right? Tesla goes up $5. I'm going to go from this 255 to 250 strike. We're going to go from 1590 to 1820. I'm going to make about the same, maybe a little bit less. So my point is, every single one of these contracts, no matter what your expiration is, they're all going to be making the same amount of money. If they go against you, though, here's the rub, right? So like if they go against you 560, and I'm going to go $5 against me, we go up to the 260 strike. This is now going to be 350. I'm going to lose about $200. Percentage-wise, that's a large percent, but it's about $200. Over here, from 850 to about 615, this is a little more than $200. You see where I'm going with this? This is like $240, $220. Over here, 1590. This is 14. This is about, it should be a little bit more, but anyways, this screenshot says it's about $200, give or take. Normally, if this was live, it'd be a little bit different. Oh, I'm sorry, that's a different, it's not 14, it's 13. So that's 260 is this strike. Sorry, this is a 260 strike over here. It's $13, $13.20. So it's about $300 something. That's the one I should be looking at. So, anyways, the more time you have, if it goes against you, the more money you actually lose. That was the point. All right, cool. So, leveraging convexity. How are we doing on time, Lexa? Well, I'm a little bit over.
I think you're totally fine.
Am I good? Are you guys good? Mm-hmm. You guys tell me. So here, I'm going to give you a couple more things. So earlier in this webinar, I told you guys about leveraging convexity, leveraging those exponential gains. And I told you we want to open slightly out of the money, we want to trim at the money, and we want to have runners in the money, right? I'm going to go back to this screen really quick. When I said 250, right, and I'm going to look at delta. So the largest delta that you ever want to have is a 70 delta. I'm just going to tell you that right now. There's a very specific reason for that, right? So as things get deeper in the money, and you can't really see it on the screenshot, we're going to start talking about something called the bid-ask spread. And the bid-ask spread is the difference between the bid and the ask on your options contract. And I know, especially as a newer trader, a lot of people will talk about like, oh, well, this brokerage doesn't charge me commissions, this brokerage charges me commissions, blah, 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 blah. Honestly, dude, you guys should not be carrying, if you're worried about a commission that's 35 cents or whatever dollars, like, you're not making enough money on your option in the first place. That's problem number one. right? The number one cost to an options trader is not a freaking fracking commission, right? You should beg to pay $100,000 in commissions a year. I'm just telling you that right now, right? The number one cost to a trader is what's called the bid-ask spread, and that's the difference between the bid and the ask here. So the deeper in the money that you go, so right here, at the money spread is 10 cents. I'm going to give you a rule right now. If you have a bid-ask spread, so if the difference between the bid and the ask on an option that you're thinking about buying is ever more than 10% of the value of the option, so if this is a $550 contract, and if the bid and the ask, the difference was more than $50, this is a no-go. Like, you do not buy that contract. Why? Because number one, you're going to get hit with at least 10%, boom, out of the gate, no matter what price does. So if you're not at least making 20% on your contract just from a price action perspective, you're not going to cover like the spread, if that makes sense. So if you don't get your move in the direction quickly, you're probably going to lose money just on that bid-ask spread alone. Number two, the deeper in the money you go, so here at the money is $10 wide, the deeper in the money you go, the wider that bid-ask spread gets. So over here, this is a $78 delta, 78 delta. This here is all of a sudden it's a $30 wide spread. It's still within that range, 10%. This test is very liquid. But the deeper in the money you go, the wider it gets. Over here, more time to expiration. The more time you have and the deeper in the money you get, the wider those bid-ask spreads go. And over here, look at this, 12 days to expiration. This is a 70 delta. This is a $100 wide spread. Can you imagine having multiple lots that have multi-$100 wide spreads? It happens to people all the time, right? So you don't ever want to have, even though they say, oh, in-the-money contracts are great, they're not that great. They're not that great because, like, yeah, it'll show you that it looks good on your brokerage statement while you own it, but go ahead and try to get out of it for that same price. It's not going to happen, right? It's not going to happen. Zephyr will tell you, right? Like, it just doesn't work that way. So the truth is, you want to take most of it at the money, and if you really leverage that exponential gain, the delta that you want to look for is something like this. So you actually want to look for something that's a 25 to 35 delta, and that's going to give you actually where the biggest convexity comes in. So that's going to be right around here. So that would be looking at like a 260 right here, 35 delta right here. And so so if you were to go 260 call and I got a 35 delta, 260 call, and I get my move up to, so $10 up to 50 delta, I trim here, I'm a double, almost a double, boom, right here, and I can hold runners, some runners to right here, that from 350 to 10, this range here, boom, this is your convexity, right, from here to here. It's not way up here, this is a very low probability of actually getting down here. This is it's a double here, but from here to here, you're gonna hold some value. It's actually a better gain over here. So hopefully that helps with my $5 bid. Yeah, you guys rock. But just as an aside, if you tend to look at things like delta, I'm skipping around these, 35 delta, that's going to be your sweet spot regardless. If you're trading, this is for equities. If you're trading something like SPY or Qs, I'm going to caveat this with those are different, right? SPY or Qs, you want to be a little bit closer to the money, right? I'll just caveat that. Something that has everyday expiration, they trade differently. So you do want to be a little bit closer to the money with something like SPY or the Qs, and definitely like SPX, very different. So equity options, there you go. And again, if you are trading Fridays, I'm not going to get super into this. That is a special situation day. All options will expire with a 1 or 0 delta, whole different deal. But again, so this is just that visual. If I buy something slightly out of the money, let's say I want to buy calls, here's just whatever, Apple trading out, I don't know, this is like 120, clearly an old slide, right? I want it to actually go through my strike price. A lot of people think that like, oh, I want it to hit my strike, and that's great, right? That is good. That's where you want to take the majority of your profits is at the money. right? And again, you can hold runners in the money, but majority of the profits need to be taken down at the money. That's when you're going to have that biggest like boom move. What's up, TV though? In the house. Most of that like big IV move is going to happen when you go from that 25, 35 delta straight to that 50. There's only that small bit, so 50 to 70 delta. 70 delta, again, slightly in the money. That's where you're maxed out. Anything deeper in the money than that, you're going to be hit with that bid-ask spread. You're going to be hit with like all kinds of other stuff that you really don't want to play with. You're going to turn into, especially if you're holding it close to expiration, then it's going to turn into something that's like a 1 delta, and you're going to be having some wild whipsaws on those option prices. So 70 deltas max that you want to hold on to. It's probably about like 3 strikes, 2 to 3 strikes in the money. That's it. So 2 to 3 strikes out of the money, taking most of them at the money, and maybe holding some runners slightly in the money, and that's it. Cool. All right. I'm just going to do a quick thing on actual Greeks. This is got some animations on this guy. I think everybody knows pretty much like the main delta, gamma, theta, vega. Just take a screenshot of this, what this is, what we talked about if you're not familiar with delta, gamma, theta. So this is just a review of what we talked about. Delta is just that measures your equity exposure. So different words, different ways to think about delta. When I said delta is like for every $1, and then I went on that quick example of like, hey, if the stock moves $1 and it's a 50 delta, the option's going to move $50. So that is a dollar representation. You can think of it as like, we call it synthetic stock equivalent. So if you have a 50 delta, that's the synthetic equivalent of having 50 shares. Does that make sense? If you have a 70 delta, that's the equivalent of having 70 shares. So if you have 70 shares and it moves up $1, you should make $70. That's how it works, right? But if you think about it, the deeper in the money it goes, the more convexity you get, right? And so that is due to what's called gamma. So gamma actually changes the value of delta. So it changes delta, and with the spot, that's like your underlying, right? So gamma is more important than delta. That's what gives you that convexity. We talked about theta, that's just time decay. Vega gives you volatility, exposure, etc. There are things that I wanted to go over. They're basically these 3 that nobody ever talks about. Forget about rho, that's not going to be a big thing, right? So couple things that people don't know about, and I think probably the biggest deal, we talked about this option stuff. Honestly, we talked about volatility pretty much like as like the main thing, right? And so if you look at this screen like right now, how many times do you see volatility, right? So volatility here, vega is volatility, right? Volatility. Everything here is measured by volatility. Volatility changes all of these Greeks, right? So if you don't understand volatility, just go back a couple slides, right? And we're talking about that probability of that average range, right? So back to that main definition. Options are priced based on the probability of something expiring at the money. And you can just look at that chart. If it's going sideways for a while and just now starting to move, then the probability is all of a sudden changing, right? And that's going to give you that volatility. And that volatility can actually change, guess what? Delta, right? Believe it or not, volatility itself will change your delta. That's called VANA. This is a big thing right here. Most people don't understand that this is not something that these 3 don't show up on any option chain at all, but these are kind of like those intangibles, right? So know that volatility is probably the number one thing that we do want to take advantage of. Understanding your true ranges, understanding your daily ranges, and when something is gone beyond, those are probably the biggest things that matter for any options trader. Right? He's here. What's up, dude? We trade something sometimes called the strat. We look for what we call inside candles, inside days, inside weeks, inside months, inside years. Those are things that we're hunting for the most part, right? We're looking for those inside breaks, and once we find something that breaks out of that inside range, then we know that we're going to get that expansion, that explosion of volatility, and we know every single contract that we're buying, if we get the direction right, is going to explode in value. All those premiums are going to pop. And those are the simple situations that we're hunting for all day long, and those are the ones that are going to make the difference for you as a trader. So again, once you have that move, we go, we take advantage. The next thing that's important is something called charm, right? And people don't know about this, right? This is not theta. This is totally different. This is extremely important. This is delta decay. If you guys have ever noticed like something, let's say you bought a Tesla 250 call, it's sitting at 200 for a week, and all of a sudden, if you happen to notice that that 250 call you bought initially is sitting at a 40 delta, 2 weeks later it's a 30 delta, 2 weeks later it's a 20 delta, delta actually decays, right? That's not theta. It's totally different. It's not even volatility, but delta itself decays, right? So remember, we said options are priced based on the probability of something expiring at the money. The less time there is, the less probability that something gets to that expiration based on the average range. That's, again, it's delta, right? Your delta decays as time goes on. It's not theta. So theta can do what it wants, right? But if you're too far and your time has gone by, it's nothing to do with theta. It has to do with the probability of something actually getting to your strike. That's it. Oh, too funny. All right, cool. I think we're pretty much there. A couple people. Does anybody use like True? I don't think anybody uses some of these more advanced things. Just as a note, since we're talking about volatility, I did want to say so. There's something not to confuse volatility with like implied volatility. Just so you know, that implied volatility is different. There's different types of volatility. So there's historical volatility, realized volatility. All this talk about volatility, I don't want you guys to get deterred just because if you're looking at an option chain, maybe something has 100% IV, right? Just because something has high IV doesn't mean that you shouldn't buy it. So that's what I want to point out here. So what we want to know is, like, again, why I've been saying look at the charts. If the chart's been going sideways, that's what's important. Just because something says on an option chain that IV is like in the hundreds, a lot of times that's totally justified, and that's totally fine. What we've been talking about is we've been talking about volatility measured against its own historical volatility, right? So that's why we want to use the charts, use average true ranges, average daily ranges, and we want to understand, like, there's a difference between implied volatility and realized volatility. So what's in an option is implied volatility. That's what the pricing model is talking about, right? What we look at on the chart, we can see realized volatility. What we're looking at from earnings perspective, we're looking at earnings option contracts, things like that. That's implied, meaning it's not real, and it's not even based on historical. It's just on what they think is going to happen, right? So it's factored for the future, and it's not necessarily based on like full historicals. It's factoring a lot of future events into that, right? So we want to think about actually looking backwards and what's historically accurate. So that's why we want to default to the charts. So quick view, right? So this is just an example. Here's something that's been so this is just a quick chart, just as a quick visual of what volatility looks like on an option. So price of a stock at the bottom, right here, and then price of a contract, like up and down axis. So red line would be an option contract, if that makes sense. So if I had a 95 put, let's say, or a $100 call, $105 call, let's say. So and this is basic volatility for $100 stock. If the volatility goes up on this stock, a $95 call or $95 put might cost about $1. That's standard volatility. This is how this is going to work. This is quick visual. A $105 call might cost about $1 with standard volatility. If this volatility moves, and let's say it has a big move up or down, or maybe there's an earnings event, volatility is all of a sudden going to change, right? So all of a sudden this is going to be like, or where'd it go? Let's say it was over here. No, oops. Now all of a sudden volatility is going to increase, right? So $100 call, $100 put was $100 call, $100 put was $5, right? And that's standard volatility. I'm just going to say 100, right? If it goes up, all of a sudden a $100 call or $100 put is $10, literally double. This is totally normal. If it continues to go up, right, volatility, it can continue to increase, and that's the type of move that we're actually trying to leverage on our end. But the second that the stock move starts to stall out, that volatility starts to shrink again. So what we want to do is we want to find ourselves in that position where, look, this $100 call or put, we want to capture it right when it's 5, and we want to jump in as the volatility is increasing and get this leverage, this exponential type of gain. And we want to start getting out. We want to get out before that volatility comes back in. GME is a good example. This is perfect. Yeah, GME is a great example. IV also moved based on interest. Yes. So the question is, IV also moved based on interest. Price stays the same for an hour, but cost-based, no interest increase. How do you gauge when it's not worth buying for the price? So I actually recommend always charting the option first before you buy it, regardless. If you don't know how to do it, you can just right-click on an option and put it into a chart in Thinkorswim. So what happens with options a lot, so the way the options work is that there are market makers on the other end. They are not looking at prices of options when they're matching your bids, right? They're just on little computers, and what they're doing is they have their little computer. They have a little computer on their end, and they're just bidding up volatility. All they care about is what IV am I able to price this at. That's their actual gauge. So the more interest there is, meaning the more volume that's coming in, they're like, okay, they're cranking up the volatility on their bids. They don't even know what price they're selling it at. They just know that they're able to get higher volatility for their ticket, and that's how they're going to make money. So the more IV that they can sell it at, look, 5 minutes ago they were selling these $100 calls at $5. Now they're able to sell it at $15. They don't really care what the stock's doing. They just know that like 5 minutes ago there was enough interest to sell it at $5, and now there's enough interest to sell it at 10, and now there's enough interest to sell it at 15. You can actually see this on an option chart live as it's happening. But the best way, honestly, is just to be able to open that option contract, see where it was trading that day intraday, and you'll see it based on like how big those moves typically were, or at least even intraday, like how big where was it trading 10 minutes ago or 5 minutes ago? Has it made that big of a move? But yeah, it's very hard to do it intraday, or if you don't have that option thing there, option chart. Otherwise, what happens is if you can't do that, back to this kind of thing, it's just we'll take a look at GME. It's as simple as looking at the chart, right? So if I'm looking at GME, the stock, right, and this is a 30-minute candlestick chart, like if there are small moves like this, and this is why if you don't have that like visual daily range kind of thing, and just as an aside, I don't know what day you're talking about, but I'll tell you that I could find a day, any day, that GameStop moves beyond its daily range. This day. This is December 7th, whatever day. This is the upside. Any day that something moves beyond its daily range, which was midday, about 11 a.m. Pacific, this day, these options, these $15 calls, $16 calls, $20 calls even, would probably have tripled at 10 a.m. Pacific at this moment, and they would have continued to double, quadruple, quintuple at this point, because that entire chain, and this is a daily range. Like for me, this is just this is a free indicator. It's totally stock. It's just I go into trading view, indicators, type in ADR. This is by a guy, Trey Peng. ADR, average daily range. Literally it. And I set it to, I set it to length 14. So remember we talked about 14-day average. Option pricing is based on a 14-day average move. So make sure you set it to 14-day average. I changed it to today only because I don't want chicken pox all over my thing. So then it'll only show you today. And then you can actually change this. I changed it to like 50% opacity, so it's not like screaming at me. And I changed it to these little circles. But this is free, right? Like we're not selling anything. This is just for you guys. I would throw this on your indicators. I don't have one for Thinkorswim or anything like that, but it's a free indicator built into TradingView, Community Script. I absolutely use this. And that's exactly how I use it. But it will tell you live. You put this on any chart, any day. Right now, right? Like on anything you want, right? Again, use CrowdStrike from today, right? Or whatever. Like it's very rare that things move beyond their daily ranges. But again, SPY on the 2nd of February, when it broke through its average daily range, you guys know what happened to those contracts that day. In just this last hour of trading, what happened to those SPY calls in just this last hour? It's because in this last hour and a half of trading, when SPY broke through its average daily range, like I'm telling you, whenever something like this happens, the entire option chain has to adjust to accommodate a new average range. And so all of them are adjusted. AMD, Jimmy. Yeah, but you know what? This tool that I'm giving you guys right now, this indicator, this is going to tell you live. You'll see it coming a mile away, right? Because this happens to come up. It shows you on your screen before it happens. Like we know, I know when something's going to break a daily range before it breaks it, and I know as it's breaking it. And that's when I say, like in my bot, when I'll say like, hey, IV pop, I'm telling you that because I'm watching something break through an average daily range. Like this. All right. Cool. I think that's good. So, I think just recap, points to remember, right? Just because a stock moves in your intended direction doesn't guarantee a profit, right? Timing matters, size matters, right? IV is the most crucial thing. We want to get in before IV is popping, right? We want to take advantage while it's building, right? We want to capture that because it doesn't stay, right? Always to consider, like, how does decay affect my value? I don't mean just theta, right? That's probably the smallest worry that you should have, right? Delta decay is huge. That's a thing, right? If you're buying time, if you're a swing trader, consider what delta decay is. It's a huge deal, right? So how is delta overall going to affect the premium, right? Am I just looking at the single delta, or what's the movement going to be, right? Over time, what's the velocity of the stock doing? All right, guys. That is it for me. Hopefully that helped. That was a lot. I think we went a little bit over. Alexa is gone, but I hope you guys enjoyed it.